Hello finance champions. Welcome to Dr. Finance, your go-to channel for clear and practical financial insights to help you make informed decisions to safeguard, grow, and manage your finances and investments. Today, we are diving into an important discussion. In this series of video, we will explore a selection of 10 stocks that I hold in my portfolio, which, unfortunately, have not been performing well. Many of you have requested insight into specific stocks, including DMART, HDFC Bank, Infosys, TCS, Asian Paints, Delta Corp, and Kotak Bank. These stocks have been facing challenges for some time now, and we'll delve into each of them in a series of videos. Our objective is to assess whether it's prudent to increase our positions, reduce them, or maintain the status quo. Additionally, we'll take a close look at the latest financial results and consider potential strategies. It's crucial to understand that the information provided in this video is not intended as a buy or sell recommendation for these stocks. The views, data, information, and graphics are shared for educational and illustrative purposes only. My perspective is based on my personal experience and analysis. However, it's important to recognize that my viewpoint is not the only one in the market, and it can be subject to error. If you find value in the transparency and effort put into these discussions, please show your support by liking, sharing, and subscribing. This will help more investors become fundamentally aware, which is the ultimate goal of this channel. Now, let's move forward with our analysis. We'll start by discussing Avenue Supermarts, known as DMART, which is one of the 10 stocks in question. Recently, DMART's financial results have left investors underwhelmed, leading to concerns. In this detailed analysis, we'll explore the salient points to gain a deeper understanding of the situation. Current challenges. Challenges in operating profit margin. DMART has been facing a significant challenge in its operating profit margin, not just in the most recent quarter but for several quarters. The critical question that arises is, why is this happening? The answer is relatively straightforward: the impact of high inflation in the current economic environment. Understanding inflation. Inflation refers to a general increase in the prices of goods and services. DMART's customer base predominantly consists of middle-class and lower-middle-class consumers who tend to be more price-conscious. This sets DMART apart from companies like HUL, which deal with high-end brands. Lack of pricing power. Unlike companies like HUL, which have the flexibility to premiumize their products and increase their prices, DMART operates on a different model. It competes primarily on the basis of offering competitive prices. The foundation of its business model is built on the premise that DMART will maintain control over its product prices and not significantly raise them. Inflationary challenges. The recent surge in inflation in the economy has taken its toll. However, there's hope as inflation appears to be easing, with some exceptions in cases of geopolitical tensions. In a high inflation environment, businesses like DMART tend to struggle. We are currently transitioning towards a world with moderate inflation rates and moderate interest rates, rather than the extremes. Impact on premium business segment. The apparel business segment, known for its high profit margins, has been hit hardest, reflecting the company's limited pricing power. Let's now take a closer look at the future prospects of DMART, considering both the positive and negative aspects. Positive triggers. Ownership of real estate. A key strength for DMART is its ownership of the real estate on which its stores are located. This is a significant advantage as it shields the company from rising rental costs. In comparison, many other FMCG players, such as Big Bazaar, rely on renting real estate. Stability amidst rising real estate costs. Over the past 3 to 4 years, the cost of real estate has nearly doubled, resulting in a significant increase in rent expenses. However, for retail stores, like the ones DMART operates, the business model remains stable due to the company's ownership of the real estate. This stability minimizes the impact of increasing costs within the company's cost structure. Focus on DMART Ready. DMART is actively concentrating on DMART Ready, its online business vertical. This segment is anticipated to exhibit higher growth rates, presenting a promising avenue for the company's future. In conclusion, despite the recent challenges faced by DMART, it possesses valuable assets and strategies that can help it adapt to changing market conditions and economic fluctuations. While the short term has been challenging, the long-term outlook for the company appears favorable due to its real estate ownership and the growth potential of its online vertical. Stock price correction and what's next? For a company like DMART, let's talk about the pricing situation. People are wondering why the stock price is going down even though it's a good company. What might happen in the future? Let me break it down for you. First, you need to know that DMART has had substantial growth over the last 2 to 2.5 years, but in the past 2.5 years, the stock hasn't seen much of a return. It's not that the company is making less profit or revenue, it's just that the growth rate has slowed down. So, how does this relate to the stock price? If you bought DMART stock a while ago and have seen it drop by around 25 to 30%, you might be concerned. The stock has been moving sideways for some time, and you might be wondering when it will start going up again. The bitter truth is, there's no guarantee in the stock market. I personally invested in DMART when it was doing well, and now I'm at a small loss, around 4 to 5%. So, why would I consider averaging down on a stock that has been moving sideways for 2 years and has dropped in price? Well, there are a couple of things to consider. The stock is now trading at a 25 to 30% discount from its peak price, and it has been in a consolidation phase for 2 years. But be prepared for the possibility of further price declines. Now, let's discuss some scenarios. One scenario is that the stock remains stable for a while and then starts to rise, giving you an opportunity for a 20 to 30% return. The other scenario is that the stock's price keeps fluctuating between 80 to 120 PE, price to earnings ratio. This kind of fluctuation has happened in the past with other companies also. The reason the stock is trading at a PE of 100 is due to the perception of its business growth, which has not been coming since last 6 to 8 quarters. Some say it's expensive, while others may see it differently. Valuation is a subjective matter, and different investors have varying opinions. The PE has come down from 310 to close to 100, which shows a good amount of contraction has already happened along with the price correction. Top on this, a time correction of approx 18 months with some catch-up by earnings addition has eased a valuation pain. However, a 100 PE can still cause epileptic seizures. I think DMART is a good stock, but you need patience and the willingness to average down if there's a PE correction. And you might be wondering why it's trading at 100 PE. Well, the majority of the shares are held by the promoters, and they are not selling them. This means there's only a small portion of the stock available to the public, which can lead to rapid PE expansion or contraction based on market sentiment. If you are not comfortable with these ups and downs or averaging down, it might be best to consider exiting your position. This is not a recommendation, but it's essential to understand the dynamics of the stock market and make informed decisions. I am not going to average it down further and wait for a couple of quarters. If the pressure of inflation is eased down, which is expected to be somewhere mid of next year, then the DMART should be back on its growth trajectory with improved operating profit margin. I hope this gives you a better understanding of the situation with DMART and what actions you can consider as an investor. Please take the information of this video as education regarding a business model of retail store business. Any views expressed here are personal and not a recommendation for any buy-sell of stocks. The sole purpose of this video is to educate the viewers to understand and analyze the highly complicated topic of finance and investment, especially in the year where rumors travels faster than radiation, so that they can take well-informed decision to protect, immune, hedge and grow their finance and investment. Be a rational investor, not the emotional. Stay connected with this channel for thorough analysis of finance and investment topic, and do not forget to like, share, subscribe and comment. Yes, I allow metaphoric trolls also. I will back soon with my analysis on second stock, and I am sure you have hit the notification bell icon to become the first one who want to doctor his financial health and wealth.